Ackman's $14 billion concentration risk. Are your bets defensible today? Welcome to today's exclusive Strategic Business Advisory Explainer, brought to you by Impact Solutions. If you allocate capital, if you sit on a corporate board, or honestly, if you just want to understand how the billionaires actually play the game, you're going to want to pay attention. We're unpacking Impact Solutions' incredible analysis right here. Let's get into it.
Here's our roadmap for this explainer. 1. The $14 billion question. 2. Conviction versus risk control. 3. Unmasking hidden macro risks. 4. The secure portfolio framework. And finally, 5. Impact's strategic takeaway.
Let's kick things off with Section 1, the $14 billion question, looking at the massive scale and structure of Pershing Square's portfolio.
Okay, to really understand the stakes of this case study, we have to look at one massive number. $13.7 billion. That's the sheer amount of U.S. equity held by Pershing Square in the first quarter of 2026. But, the absolute dollar amount isn't actually what should make your jaw drop. It's the fact that this astronomical sum is concentrated across just 11 total stock positions. 11! Just think about that for a second. When you squeeze that much capital into so few names, you're basically engineering a high-stakes stress test for yourself. Because if even a small fraction of those investment theses crack, substantial capital is immediately, and I mean immediately, at risk.
So, how is that $13.7 billion actually sliced up? Well, the top 5 positions alone represent a staggering 78% of the total reported holdings. But let's zoom in even closer on those core pillars. You've got Brookfield sitting at 17.6%, Amazon at 17.4%, and Uber at 15.7%. Those 3 companies alone eat up more than half of the entire portfolio. Obviously, this isn't an accident, right? It reflects a highly deliberate, high-conviction strategy. It rolls alternative assets, cloud computing, and mobility platforms into one giant bet. But as Impact Solutions brilliantly points out, a structure like this really forces us to ask, is this extreme concentration actually supported by durable cash flow and disciplined downside protection?
Moving right along to Section 2, Conviction versus Risk Control. The absolute danger of assuming confidence equals safety.
Impact Solutions lays down a totally critical rule here, and I quote, "High conviction does not eliminate concentration risk, correlation risk, or drawdown risk." The big takeaway? Just because you believe deeply in a company's management team or you love their execution strategy, that doesn't magically vaporize your financial vulnerability. Sure, high conviction might streamline your decisions and tune out the daily market noise, but it absolutely does not act as a shield if macroeconomic conditions suddenly flip on you. Institutional conviction is definitely not the same thing as institutional risk management. It's incredibly easy to fall into the trap of thinking you're perfectly diversified just because you own, say, an e-commerce giant, a ride-sharing mobility platform, and a real estate asset manager. But guys, that is merely company diversification. You just own different brand names. True economic diversification is about building a fortress against shared macroeconomic triggers. A portfolio can look completely beautifully diversified based on the logo sitting on your spreadsheet, while in reality, it's highly concentrated and utterly exposed to the exact same global liquidity conditions and consumer demand shifts.
Which brings us perfectly to Section 3, Unmasking Hidden Macro Risks, or Understanding the Shared Vulnerabilities in Diverse Sectors.
Okay, check this out. In Q1 of 2026, Amazon posted a massive $181.5 billion in sales. Uber flexed some huge strength with $53.7 billion in gross bookings. And Brookfield reported $1.6 billion in distributable earnings. Those are massive, super powerful numbers, right? But let's peel back the layers and expose the hidden macro risk here. Amazon's colossal AI and cloud infrastructure spending could really suffocate their free cash flow if enterprise demand starts to cool off. Uber's platform, it's heavily exposed to consumer discretionary spending shrinking and, of course, regulatory changes. And Brookfield's long-duration asset base is incredibly sensitive to rising interest rates and financing costs. So despite operating in completely different industries, all 3 of these pillars share major vulnerabilities to rates, to inflation, and to the cost of capital. They are effectively tethered together by the broader macroeconomy.
To grasp why those shared vulnerabilities are so crucial right now, we really need to look at the IMF's global growth outlook. We saw a 3.5% average growth across 2024 and 2025, but the projection dips down to a flat 3.0% for 2026, before slightly bouncing back to 3.4% in 2027. So, why does a global dip matter so much for a concentrated portfolio? Well, because in a tightening macroeconomic environment, one with lower global growth, potential commodity shocks, and stubborn inflation uncertainty, those hidden correlations we just talked about, they get triggered. A tightening environment dramatically amplifies concentrated losses if valuation multiples or capital expenditure forecasts start to deteriorate.
Let's turn to some solutions in Section 4, the Secure Portfolio Framework, which is L-Impact's playbook for downside protection.
So L-Impact outlines these really critical steps to ensure your investing is governed by hard, cold evidence, rather than just coasting on a famous reputation or past performance. Step 1 is establishing a formal concentration framework. Basically, institutional investors should define strict maximum weight thresholds, think 10 to 15%, and literally only exceed them if they meet rigorous, board-approved criteria. Step 2 is to map shared macro variables. You have to map out how things like inflation, real interest rates, and recession probabilities impact all of your holdings at the exact same time. And step 3 is implementing adverse scenario modeling. You absolutely have to stress test your cash flow under worst-case conditions, like what happens if AI adoption slows down for Amazon or Uber hits a massive regulatory wall.
Central to this whole framework is the concept of dynamic rebalancing. What this means is trimming or adjusting your holdings based on predefined rules when a stock's price appreciation completely outpaces its actual underlying business fundamentals. And you do this proactively, rather than waiting for massive market losses to eventually force your hand. This is just vitally important today, especially when you're looking at narrative-driven sectors like AI, infrastructure, or these big platform businesses. Because let's face it, market momentum and hype can drive valuations up way faster than actual cash flow growth. You simply need a disciplined rule to take chips off the table when the math just stops making sense.
To stop concentration risk from turning into a full-blown, catastrophic drawdown, L-Impact Solutions provides 5 specific prevention methods. Number 1, don't just blindly copy quarterly SEC 13F filings. You have to evaluate the timing lag in derivative exposure. Number 2, establish specific early warning indicators for every single holding, like, for example, strictly tracking AWS revenue growth for Amazon. Number 3, elevate your macro stress testing to a strict board-level requirement. Number 4, create predefined exit and reduction rules, basically to prevent any emotional attachment to a stock. And number 5, integrate liquidity planning. You need to know exactly how many trading days it's going to take to unwind a massive position during a market panic without actually crashing the price yourself.
Honestly, if you only take away one granular piece of financial advice from this explainer today, please let it be this. Require clear cash flow conversion tests before you ever assign premium valuation multiples. Let's use Amazon as the example again here. Sure, they generate massive top-line revenue, but strong revenue growth does not automatically equal true shareholder value. Value is only created if those incremental, massive capital investments, like building out endless AI data centers across the globe, actually produce returns that sit comfortably above the company's cost of capital. You have to look past the flashy sales numbers and demand clear cash flow conversion.
And that brings us to our final section, Section 5, L-Impact's strategic takeaway, focusing on disciplined concentration.
As L-Impact points out, the absolute strongest strategy isn't just mindlessly owning a tiny little piece of everything, nor is it recklessly betting the entire farm on 3 tech stocks. The real answer? Disciplined concentration. It means having completely transparent governance, incredibly rigorous financial modeling, and continuous, unblinking risk monitoring. You really have to evaluate your own governance and stress testing controls today, because at the end of the day, portfolios don't usually fail from a lack of good ideas. They fail because we forget to quantify correlation and capital fragility.
So I want to leave you with this question. Is your portfolio built on blind diversification or disciplined concentration? A huge thank you to L-Impact Solutions for providing the incredible strategic insights that powered this Advisory Explainer podcast today. Their ability to dissect complex capital allocation risks is just truly top tier. For more strategic analyses, visit our website, link in description below. Stay focused, stay disciplined, and I'll catch you in the next explainer.